Well, thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. You can say that this is almost by demand. So many of you wrote to me to get in Laurus Labs conversation going after the Q4 numbers, and it was a splendid show. Let's get in Dr. Satyanarayana Chava. He's founder and MD. Needs no introduction, really. Joins us on the show to talk about, well, briefly about how the quarter went by, which was anyways good, but how does he see the next 12, 24, 36 months as well? Dr. Chava, good having you. Thanks so much for joining in. And I hope all is safe.
All are safe, Neeraj, and good morning to you and your colleagues.
Thank you so much, sir. So let's start off with my principal question. I mean, this FY21 performance, I'm not just taking Q4, which was anyways a splendid quarter, but when I look at FY21, a broad-based 70% top-line growth indicates multi-pronged capabilities. I think if we say that any doubts regarding the capabilities part have been cleared off in FY21, now people now just want to know about how would Laurus Labs execute the next leg of growth, if you will. So how is FY22 looking? Because you have, I think, API capacities coming on stream this month or the next, a formulations facility coming in August, if I'm not wrong, and then some more which is known to the markets. Can you talk about this?
There is our growth in FY22 is already cemented. We have products filed, approved, what we are going to sell. We know how much we are going to make. There are some capacity additions needed to achieve our numbers in FY22. That's what we have done in the last financial year. So we increased our capex numbers in FY21 also, and we also made it clear to our stakeholders in our investor call. We increased our guidance and capex to 15 to 1700 crores in FY22 and FY23 put together. Our capex numbers in FY22 partly will be utilized for sales in FY22 because most of these investments are in brownfield. Once the facilities are qualified and validated, we can start selling to our customers. But majority of the capex earmarked for FY23 and part of FY22 are for growth in FY23 and beyond. If you look at the FY21 was a transformation year for us. Is a validation of our conviction. Capacity is required to gain more market share, to gain customer confidence, and also to maintain commitments to delivery and commitments to quality. Our 70% growth in FY21 came because we have invested significantly in capacity expansion in all verticals, API formulation as well as synthesis business. Going forward, most of our capex will be for non-antiretrovirals. So far, our majority growth drivers are antiretrovirals, both APIs and formulations. But from FY23 onwards, we do strongly believe the growth will be driven by non-ARV APIs, non-ARV formulations, and also predominantly now from custom synthesis. And also, FY22 will be also a transformation year for our Bengaluru Laurus Bio, because they are about to start a commercial production from their expanded fermentation capabilities. So FY22, again, we are doing a lot of investment building pillars for our future growth. That's the way I would say our FY22 growth is well within our reach.
Okay. I would want to ask you why this focus on non-ARVs as well. Is it because the other products are better return and better margin numbers? But I'll come to that in a bit. Let me go piece by piece, Dr. Chava. At the end of Q4, my first set of questions, at the end of Q4, backed by very strong ARV-API revenue, as you mentioned yourself, the API contribution was as high as 53%. I think the last time that we spoke, you mentioned that loosely 40-40-20 would be the 5-year target. But for now, API was about 53%. Now, I presume that such strong trends as exhibited by ARV APIs in Q4, don't die down in a quarter. So are we to say, or are we to see that despite you saying that post FY23, the focus will not be on ARV APIs as much as some of the other products, for the near term, the API revenue to drive growth, Q1, Q2, maybe FY22?
We do see growth in APIs. We do see growth in ARV APIs as well as formulations in FY22. But we don't see significant growth coming from ARVs, both APIs and formulation, from FY23 onwards. The reason, the number of patients who are coming under the treatment is going down because the new infections are coming down in HIV, and then most of the people who are taking HIV medications, there is no increased transmission. So we do believe FY23, the number of, maybe FY23 is a maybe little aggressive number, but FY24, FY25, we do see the ARV sales, ARV patients who are on the treatment will be plateaued. So then I don't see there will be growth beyond FY23. That's the reason. But our R&D engine, our manufacturing engine, still doing fantastic work. So our growth beyond FY23 will come from non-ARVs. And we were saying this for last 2 years, and we are saying now. So we have a lot of visibility what we are going to do in FY23 onwards, especially in the diabetes and cardiovascular segment. We do see significant growth coming for us.
Okay, interesting. Then I would want to know in a bit about where would that $1 billion target for FY23, how would the composition of that be on the operational front as well? But speaking of that, sir, I believe in the con call as well as in some other interviews, you've reiterated fairly confidently that never mind the pricing pressures of raw materials, never mind the fact that newer capacities are coming on stream and therefore utilization rates may not be that high, you will still very ably defend the 30% EBITDA mark, which was the highlight, I think, one of the highlights in FY21. What gives you the confidence to do this? And do you reckon that this is now the new base, or this is the target that you want to keep? What I'm trying to get it as that, can this 30% become 30 to 33% in 2-3 years? Or do you believe that you want to defend 30% because it's a formidable target to have on the operational front?
See, the FY21, we have seen a lot of operational leverage. We have spent more money on R&D, but as a percentage terms, almost 3% less, more than 3% less when compared to FY20. Our manpower cost rationalization were very visible. Our operational cost rationalization were very visible. So we have seen operational leverage in FY21. If we grow beyond 25% top line, and we still believe operational leverage will be there. So when we mentioned our goal to achieve 1 billion revenue by FY23, we still believe we will have operational leverage coming in FY22 as well as in FY23. So our guidance of maintaining the EBITDA margins above 30% is going to happen. And see, generally we don't give any indication to our investors, but we are saying two things right now. We will target to achieve 1 billion revenue by FY23 and also maintain EBITDA margins above 30%. As you mentioned, we do believe that 30% will be the new base. How much we go beyond 30%, we would like to do as more as possible, but people can take 30% could be our new base for EBITDA number.
Okay. And typically, Dr. Chava, I mean, I'm just talking about normal businesses. You're the best judge of your business, really. But normally, when new capacities come on stream, when CapEx is undertaken, return ratios do take a bit of a hit. In this pursuit for growth, which is fine, which is great, markets love it. But in this pursuit for growth, do you reckon that temporarily, for the next couple of years, maybe as we see it, do you reckon return ratios could come off? I mean, there's a report, I think, from Motilal Oswal, if I'm not wrong, which says that in the near term, for the next 2 years, that is, I'm talking 2 years as near term, that your ROEs, for example, could compress from circa 45% to about 35 odd percent because of all of these factors. Do you think that's a possibility?
Because of heavy capex we are planning to do, mostly brownfield, and also we acquired additional parcels of land for our growth, both in API formulations as well as custom synthesis. There will be some reduction possible in our ROCE and ROE, but we don't see that will have any impact on our margins. If you look at the EBITDA base, became significantly larger when compared to FY20 in FY21. When we do believe that number will be bigger in FY22. So when we do greenfield capex, creating new manufacturing locations for our divisions, we do have some pre-operative expenditure, but that number is not going to impact our bigger base. So we don't see our EBITDA margins will come under stress. But ROCE or ROE will come down to some extent. But we need to invest in growth. So growth
Yes.
will come from our investment. So we are not worried to invest. See, today, our investments, we are very clear what product we are investing, what capacity we are investing, which location we are investing. See, we are very cautious in investment. But we need to deliver what we committed to our partners. So our partners depend on us for life-saving medicines, and for the sake of becoming debt-free or increasing our ratios, we cannot stop investing. So we are investing, but we are having a lot of judgment within our team, a lot of deliberations are happening within our team, and we are investing very cautiously.
Sure. Suffice to say, sir, that your asset turn would be around 1.5, 1.5 times. Would that be a safe assessment?
Yes, you could take that broad number, around 1.5 asset turnover ratio. See, if you look at our growth, our growth came from our investments. Our growth never came from any acquisitions. So we are a company where we like putting capex on the ground, build the infrastructure the way we need, invest in scale. So broadly, I think our growth in the next 4 or 5 years will only come from our own products, our own facilities, and coming from our in-house R&D developments.
It's interesting you say that. So many people, and I attended a webinar of somebody who probably understands your business very, very well. And the person and many other people are of the belief that your growth or the next leg of very high quality growth will come in from your latest acquisition, which is Richmore. Tell us a bit about Laurus Bio, because it is at a very nascent stage. And I think when you did it as well, there were people who believed that you overpaid, but there were people who understand this business very well who said that you actually made a really good bargain deal for yourself. Can you tell us a bit about Laurus Bio, not just the immediate plans that you have, but some more color, because it's a less understood part of your business, so to say.
Take our verticals, Neeraj. For API, for us to become a respectable player, it took 7-8 years. For synthesis business, it took 10 years. For formulation business, for us to play a reasonable play, took 5 years. We started investment in 2014. It took 5 years. 2019, we saw revenues coming in. Whereas biotechnology, we have no expertise. See, we are not saints where we can do everything. So we know our limitations. We know what we don't know very well. So we realized our gaps in our expertise. Biotechnology is an area where we wanted to grow. So we acquired talent. We didn't acquire Richcore company. See, when you look at what we acquired 17,500 liters fermentation capacity and 100 member team and committed founders. So we invested on them. And true to our belief, they are doing very good. And their commercial facility will go live probably in this week. And we already started looking at putting up a 1 million liter fermentation capacity. See, people should understand we curtailed our entry into biotechnology by 5 to 7 years by acquiring Richcore and renaming it as Laurus Bio. So we started the journey much ahead of others because of this acquisition of team. I would say, I still say we acquired the team. We didn't acquire the company. Yeah.
Dr. Chava, I'm hungry for a bit more. I'm not disputing that one bit that you acquired a team and not a company. But when you acquired this team, you had some thoughts of what this team would deliver for Laurus Labs in, say, 5 years' time. I'm not talking about 1-2 years. And which is why you're agreeing, or you've taken up this endeavor to set up the 1 million liter capacity as well, right? Tell us a bit about how
Sure.
what Laurus Bio could be 5 years out from where it is right now.
See, if you look at the India last edge in fermentation, now it is trying to gain advantage of fermentation by investing into core infrastructure. When it comes to Laurus Bio, our teams have expertise in cell culture ingredients, which are widely used in many fermentations, including vaccines and other monoclonal antibody production. They do make a lot of cell culture ingredients, but that business cannot be scalable. We can't achieve 100 million sale from cell culture ingredients. It is difficult. So what they have done is went into recombinant proteins for food. So that's where our current focus is, and our current capacity will be fully utilized for mostly for one customer, and we have a lot of interest from other customers. So we are at the drawing board stage to build, to start with very large facility, and we will build 1 million liters, which can expand to maybe beyond 2 million liters fermentation volume. So that's the medium term. In the medium term, we also wanted to focus on fermentation-based APIs or fermentation-based intermediates for pharmaceutical industry. So we have immediate medium-term focus is investment into large fermentation capacity to cater to monoclonal, not recombinant proteins for food to start with, and also fermentation of intermediates for food and for pharmaceutical use. In our long term, we will also invest in recombinant proteins for therapeutic use. That's our maybe 2024 onwards. So we will start investment into building a pharmaceutical grade recombinant proteins. That's beginning 2024. So the medium term is recombinant proteins for food and fermentation of pharmaceutical intermediates and APIs. And the long term is putting up a respected large-scale CDMO facility for pharmaceutical use, especially for recombinant proteins. That's the broad view for our bio strategy, Neeraj.
Okay, sir. I understand you're running short of time. I have 3 quick questions, so I will pursue them one after the other. The first is a follow-up to the initial question, initial answer that you gave, that FY23 onwards, ARV or APIs will not be the key growth driver, it will be the other businesses. Now, this is a conscious strategy decision, I'm sure. You briefly explained to me why. For the APIs alone, can I ask you why that vision for the console business? Is it because the other businesses over a period of time would just put you in a better return, better margin, and better customer profile? Why this game plan?
Our investments into non-ARVs is not because other APIs or formulations are more profitable. We wanted to grow this business beyond just ARV. So you cannot grow in ARV forever. See, as you mentioned, are we compromising our return ratios for growth? We don't want to do that. So we don't want to grab more market share by cutting prices. That is not our intent. So we want to have a live and let live strategy. So we want to have a sustainable business. With that approach, we cannot grow in ARV forever. See, ARVs, I do believe getting 35-40% market share is big. Beyond that, it's not possible, because the agencies who award these tenders, they will not award to one company all the tenders. So tenders, majority of tenders are not winner takes all. They distribute the tenders very well spread, because they want a sustainable ARV players. So beyond 23, we don't believe revenue growth will come from ARV, both APIs or formulations. But we do believe diabetes. There are a lot of new products going off patent in diabetic segment. So FY23 onwards, our growth in diabetes is going to be significant. We have full basket of APIs and formulations in diabetes. And FY24 onwards, we are building a portfolio in cardiovascular that will start commercialization in 24. So these therapies, diabetes as well as cardiovascular, we do believe are good bets for us going forward. So our investment into those, based on our judgment, that we do believe we will get significant market share in diabetes, both API and formulations as well as cardiovascular. So we are doing as per our strengths. We are doing as per our timelines. We are not in a rush to do products. So we wanted to gain leadership in what we do, rather than try to do 10 ANDAs and one will click. See, our approach is not that. When we work towards filing an ANDA, we do believe we want to get market share. That's the reason our portfolio is small, very highly focused portfolio, and we do believe that is paying off. See, if you look at our strength is investment into process, investment into scale, investment into partnerships, that making us winners, rather than trying to develop 50 DMFs and 50 ANDAs every year.
Okay, I had a question on the contribution of segments, but there is very little time left, because I understand you have a meeting to rush to. So I'll just ask one final question, Dr. Chava, and that's around whether you will need to play around, alter your stakes in the company in any fashion whatsoever over the course of the next 12 months for any kind of needs that may arise on the personal front. There has been a lot of due or undue chatter around this, as you would have heard as well. Can you clear the air once and for all?
We don't need to do any stake sale even in the long term. So now our needs were met, and all my pledge was released. I made it very clear, and we don't see any need further, and probably we will try to invest in adjacencies in the near future, personally as well. But other than that, we don't see any stake sale requirement. At the same time, even company also don't need any additional capital. So our capex, what we envisaged, will be met through our internal accruals itself. So we don't see any capital raise in the company, and personally also I don't need any money through stake sale, even in the long term.
Nor in the near future, nor in the long term. I'm taking that as an answer.
Yes.
Okay.
Yes.
Okay, fair call. Dr. Chava, lovely talking. I focused on the long term a bit because this was the end of the year conversation. Next quarter onwards, we'll talk about the short term a little bit more. But thank you so much for speaking to us today, and stay safe, Dr. Chava.
Thank you, Neeraj, for your insightful questions. Thank you. Please take care.
Pleasure having you, sir. Stay safe. And viewers, thanks for tuning into this edition of The Talking Point.
Thank you.
Wonderful. Yesterday